We got so many wild cards. We talked about the sovereign wealth fund. We've talked about the gold green card. We talked about, there's so many different things that happen in the market. Any one of them can be a 10% move in either direction. So I don't
And
know.
that's right, Fred. And so what I've been trying to do is kind of stack them as priority as to the weighting, because these models, I mean, everything's computer driven today, right? You've got $1 trillion funds that have models and they're computer driven buying and selling, which is one of the reasons why these moves just
So fast.
crash.
Yeah.
You're down 100, 200, 300, 400. I don't doubt that in this interim period, as Tim alluded to, going from transitioning from a government based spending economy to a private sector, what I think that the marketplace is going to have to realize is that when we unleash the beast of the private sector, I mean, look out. You're going to end up 3% growth, 4% growth is not going to be.
Hey, everybody, welcome back to Markets and Madness. As we like to say, the place where we discuss the madness that occurs when politics, economics, and personalities all move in different directions. We have an old friend with us today, Steve Flanagan. Steve's been on a couple of times, and we haven't spoken in, I guess, several weeks. So we thought it was a great time to get him on board, talk about what's developed, what's happening, where we're going. So Tim is with us as well. Good morning, guys. How's everybody doing?
Howdy.
Doing good, Fred. Yet again, the best theory in trading comes to truth, and that is whatever the market does for the first 2 weeks of January, the rest of the quarter, it's unwind.
That's right. I used to have a client when I was working at Swiss Bank. He was Kamel. He was a crazy man. Renault Finance. He was one of the biggest traders in the world in the currency markets back then. And I would call him up, second week of January. Hey, Kamel, let's go. What are you thinking? My dear, I don't trade in January. All the cowboys are out. Let them shoot themselves. I'll come in February and sweep up. He would say.
That's right.
That's right.
His famous quote, when you finish changing your price, I am going to give you.
You cannot hide from me.
I will hunt you down like a dog.
And then I will give you 20 more.
That's right. That's right.
Yeah,
Oh boy.
he was one of a kind. So we've got a lot of things going on in the first, 6 weeks of this administration. I know you were very dollar bullish, very pro on the U.S., and dollar seems like it's gone the other way. Well, what are you thinking? Have you changed your opinions at all?
So, in the bigger picture, no, absolutely not. I think once we hit around May or June, I think the King dollar will take over, and I think you'll see dollar index above 110. Having said that, though, I have to admit that, I did, stop myself out from a position as I kept looking around the 106.5 level. Once that broke, it was, let's just let this breathe. But what I think the biggest item that came out in the marketplace was the fact that Germany is taking the foot off the brake, and we're going to see fiscal spending. I think they're talking a $500 billion fund for defense and infrastructure spending. So this is a cataclysmic change in the environment in which we were in. And what that means for Europe is probably a very positive future. Let's see how this all comes to fruition. But this is a very positive change in the bigger picture. I think you may not see that probably for a good 6 months to a year out. In that interim, I think now that the market has redigested the new data into their equations, we can see what's happened. Every single market has reacted in the financial landscape here.
Yeah, we've been talking about that. Tim, you wanted to jump in?
Well, that's the question. Have we redigested at this point? I don't know that we have. Fred and I have had this scenario that seems to be playing out. Uh, we tried to put time frames on it yesterday, in fact. Um, we think that this, what now the markets are calling it a transition. Of course, Trump called it a transition. We've used the metaphor of Trump's a builder and he's knocking down his building and he's putting in a new plant and we're living in smoke and debris. And the question is how long is that going to go? Under normal circumstances, I would say 6 to 9 months. Under Trump's circumstances, I got to go 3 to 6 months.
Yeah.
And the transition is occurring because he's transitioning the economy from a public sector driven economy to a private sector driven economy. And the public sector piece comes first as he cuts out uh, the employment, and those employment numbers start to look, all that public sector employment dwindles, and everything attached to that, which is the contractors, the people, the wife of the guy who's getting laid off in the public sector. We think all of that is going to take some time to boil out. And we don't know how long that is, but I'm thinking anywhere between, say, 4 and 8 months, which puts us, since we're in March, we're talking about the summer to the fall. So really by year end, my screen went out, Fred.
Yep. We can still hear you though, Tim.
Okay. By year end, I think by year end, we should start to see the benefits. But the question, I'm really picking up on your comment. You said we've repriced. I don't know that we've repriced it in. I think we got a few months to go through repricing. Would you agree with that or take that apart?
Well, I think in today's electronic world, and this has been echoed by Bank of England board member Mann, where she said that the adjustments that the central banks have to take need to be more aggressive. In other words, 1/4% is just like it means nothing to the marketplace today. And she was advocating 0.5% or more when the central banks need to adjust because of the electronic nature of our markets. When things change, they change immediately. So do I think it's been fully priced in? No. But I think that the bulk of the selling in the financial markets, whether it's crypto, whether it's unloading treasuries, whether it's equities, or in this case, the dollar, I think that the bulk of that is done. I don't think you're going to reverse immediately, but I think that you should probably find the base is probably just about in. May still see another spike low, but I think you'll probably now trade in a sideways pattern down here until we begin to see the developments, coming to light, such as a budget agreement in the United States. That would be very big.
I'm still pretty bearish. I'm bearish on the dollar in the short term. I think euro is what I did some quick Fibonacci numbers the other day. 52-week highs and lows, 112 to 102. We were at the 618, the two-third retracement at 108 and change. We broke through that. We're going to go back to 112. So that's another 3-4% move higher in the euro, lower in the dollar. Equities, I think we could go down to the Dow down to 35,000, 34,000. I think that's the two-thirds retracement of that move. Another 20% down, 15% down in the Dow. I don't think anybody's prepared for it. We always talk about the trade of most pain. Everybody got
Mm.
long the dollar. Everybody got long equities going into the new administration, and it's reversing itself. We did something yesterday, and I put a quick short out. It said political Seinfeld episode. If Biden is good for the dollar, Trump is bad for the dollar.
Yeah, yeah, yeah.
Opposites. Do the opposite, and it seems to be playing out. We'll see how long it goes. It's interesting. Besant had a comment. I don't know if you saw the interview that he did on CNBC on Friday. It's the most in-depth interview I've seen with the Treasury Secretary in my lifetime. It was 42 minutes, answered every question, spoke on every topic, was very, made things make sense, of what their plan is, how they're going to move things. And he said, administrations have been trying for 30 years to get Europe to increase their defense budget, and Trump did it in 2 months.
Yeah.
you know, you
Yeah.
know. So what's that mean overall? Is Germany really going to step up? I've had this argument.
Okay, am I back?
You are
Yes, you are.
back. I've had this argument with, not argument, but conversation with a couple of friends, European friends, about the Trump Zelensky meeting in the Oval Office and how that blew up and how Trump is turning his back on NATO. Zelensky's not NATO yet, and that's the problem, you know. But I think overall, we've said it a number of times. We've had to borrow money in order to give it away, and
That's
now,
right.
how much is the European population going to be comfortable borrowing money to give it away, putting their troops on the ground, their boys in harm's way? I don't know. I mean, I don't know where that's going to go, but that's another wild card. We've got so many wild cards. We talked about the sovereign wealth fund. We've talked about the gold green card. We talked about, there's so many different things that are happening in the market. Any one of them can be a 10% move in either direction. So I don't
And
know
that,
where
and
that's.
that's right, Fred. And so what I've been trying to do is kind of stack them as priority as to the weighting, because these models, I mean, everything's computer driven today, right? You've got $1 trillion funds that have models and they're computer driven buying and selling, which is one of the reasons why these moves just
So flat.
crash.
Yeah.
You're down 100, 200, 300, 400. I don't doubt that in this interim period, as Tim alluded to, going from transitioning from a government based spending economy to a private sector, what I think that the marketplace is going to have to realize is that when we unleash the beast of the private sector, I mean, look out. You're going to end up 3% growth, 4% growth is not going to be uncommon, because what they realize, and I'm going to go back and watch that interview you referred to, what they're realizing that in order to get out of this problem, it's you've got to create growth, because we're going to have to grow our way out. Now, you're mentioning different things. So peace in the Ukraine, Russia, that looks like that's going to be on the cards soon. Um, or is the Abram Accord going to get reignited throughout the Middle East, and we're going to have a huge peace agreement there? That looks like it's in the cards. One of the other things is this talk about revaluating U.S. gold holdings, the largest holder in the world at $42.20 right now an ounce we value it. Talk about, what about if we revalue? What about if we revalue the land and the buildings that our government
Or
owns?
sell off the buildings. We've been talking about that for a while too. Sell off some of those buildings that are a
But
drain.
all that's timing. All of that impacts the timing. I was thinking one small, in my mind, I was trying to add up depressants versus stimulants. And then I was trying to lay the time frames out between the two. And one of the stimulants that I was thinking about that nobody has talked about is this idea of no tax on overtime.
Wow.
Just you take something like that and productivity soars, you know? And it's just one of those variables that we're not even thinking about. It's just one of those small variables.
And no tax on tips. I mean, there's a lot of our workforce that, lives day to day. Suddenly, if you're not taxing tips, I mean, that's, potentially a lot more spending power to
Yeah,
the
in
economy.
terms of available disposable income, but in
That's right.
terms of incentives to produce, no tax on overtime, all
That's
of a sudden,
huge.
yeah, and that's a big blue collar stimulus right down at the lower end of the economy or the middle of
Right.
the economy, lower
Being
middle
Right.
pushed with the
probably blue
tax
collar.
to offset the tax for the billionaires, which you can't please people.
No.
There's no
Un-
billionaires that are working overtime that I know of.
no. Unfortunately, we're in this world where everything, I mean, just look at the speech in front of Congress. I mean, holding signs up. I mean, nobody is going to on one side of the party line is going to vote for this continuing resolution. And it's like government just still is not working for anybody. Just because you're on that team, we're not voting, even if it makes sense. Um, so when we get over that hurdle, then things can start happening.
Yeah.
But I don't know when we're going to get over that
Well,
hurdle.
I mean, if you're Trump now, and you are now the new head of the Republican Party, the next midterm is the election, the midterm election, and that he's got to have everything done by then, and
Oh
that's
yeah.
that's like a year and 8 months away, maybe something like
Yep.
that, from the way I see it now. So he's got to accelerate this process, and he's got to do everything he can to do it. And the Democrats are trying to play a waiting game. They're tying him up in court, doing whatever they can, shopping for judges, anything they can delay the game and run out the clock. That's their game. So
Yep.
as long as there is a majority, and as long as everybody stays healthy and nobody dies and changes the mix in Congress, that's a real issue. You know.
I did hear last week that some Democrat, I don't know if it was in Colorado or somewhere, one of the Midwestern states, I
Get
thought,
close to the mic, Fred.
was moving from Democrat to Republican.
Really?
Oh, I
Somebody,
didn't hear that.
I heard that last week, and I don't remember who, but that's one more that would caucus with the conservatives and would be, every little bit helps the process, right?
Yeah, and Tim, I think you make a very valid point that I figure you've got 3 to 4 months to get everything in motion. Then it starts kicking in by year end because the campaign season by April of next year has begun
Right.
for the Congress. And if things are working, I would have to think that you're looking at probably a much larger majority if things are working. So, I mean, are you going to run the clock out? That's one strategy. But I think America is like, listen, what are you going to do for us? I think one of the ideas I heard floated was this maybe 10 to 20% of the Doge savings goes back to the taxpayers as a rebate. I think you start getting into that, and that becomes a very huge voter.
Tim's, do you want to expand on your ideas
Yeah,
of
I
why?
was thinking that uh, Trump sees that as a replacement for Fed stimulus,
Yes,
right? In other words, he doesn't have to rely on the Fed reducing rates. That's
oh,
monetary
good point,
stimulus.
Tim. Yeah,
Yeah, so he's moving toward fiscal stimulus, and that would be a direct fiscal injection, you know? In other words, he doesn't
Without
have to
creating new
borrow to
currency.
stimulate. Uh,
Yeah.
he just gives back some of the Doge to stimulate. And I really think that's what's behind that, in addition to placating the base.
yeah, and that's a massive popular movement. Again, with no taxes tips, no taxes
Yeah.
overtime, and now our government's been wasting your money. Here's a piece of it back. I mean, oh man.
How do you fight that?
Yeah, this
Yeah,
guy's thinking in three-dimensional chess terms. You know?
yeah, how do you vote against that though if you're in Congress? Well, we're all not going to vote for anything they suggest. Okay, well, who's going to vote that person in next time?
Right. A lot of these guys are going to be primaried if
Well,
they
what
get the
they'll do
chance.
is they'll play it. The Democrats will play it and say, "Yeah, he told you he was going to reduce the debt, but in fact, he's just giving us money." But I don't think it'll play with the public. I think it's going to be a
Yeah.
weak
Yeah.
argument.
And the other spin is going to be the only reason why he's doing this so he can give the billionaires major tax breaks. You know,
Well, that'll be the spin, but then again, a check in my pocket.
I think that's fallen on deaf ears. You
Yeah,
know, I
I
think
do.
that's
It's an old tried. It's like, you're the Gestapo, it's the Nazis. These are old things that people are like, yeah, okay, sure. But, the things that we're talking about is why I'm not giving up on my King Dollar. I do believe that, as we get past June, June is my point where I think things begin to take off. But I would say that I have to see a budget. I got to see elected representatives or legislative branches pass a budget.
What happens if they close the government down on Friday? Is that
Um,
positive or negative?
well, I think in this environment right now, it's a negative.
Not for the bond market. It's a big positive for
Right.
the bond market.
Yeah.
Stocks, another story.
Yeah.
Stocks down, but stocks down, the interest rates come down, right? And suddenly, remember, 1/6 of our population of our GDP is dependent on home building or housing sales, and that is a depressed area of our economy right now. You're putting interest rates down right now. You're going to open up an entire sector of the market that's been dying to buy homes.
Well, that was a piece that I mentioned this to Tim yesterday. I think it was Maria Bartiromo talking to Trump, saying the stock market's getting sold off. He says, "Yeah, but the 10-year Treasury rate is down. Mortgage rates are down."
Yeah,
So,
yeah,
so
No
he's
less
got the
than
stock
Lacey
market.
Hunt said to me once, the stock market is so dependent on housing. You use 1/6. I would think it's probably closer to 1/3.
mm,
Although I'm not an economist, I certainly have not run the numbers. But I worked with a guy at Eurobrokers one time, and he said to me, "I'm buying a house, and I think we stretch in it, but I can afford it." And I said, "Well, let me tell you where you're going to run into trouble: a ladder." And he said, "A ladder." I said, "Yeah, you got a problem with a ladder. Do you have a ladder?" He said, "No." I said, "Let me tell you what your toolbox looks like. You got a hammer, you got a pair of pliers and a screwdriver, and then maybe some nuts and bolts." He said, "Yeah, exactly." I said, "Right." So it was before Home Depot days. I said, "You're going to be at Home Depot or Ace Hardware, every day. You're going to need a hose. You got a hose? No, I don't have a hose. You got a ladder? No, I don't have a ladder. You got a wrench? No, I don't have a wrench. You're going to need all these things, and that's the point. You got furniture to put in this house? No, I got to buy a living room set. Okay, and that's the point of housing. It's not so
yeah,
much the mortgage, and that's what you can afford. It's everything else. It drives the
There was
whole
a
economy.
guy I
yeah.
work with that you know well, Tim, Bob McGraby. He used to have the furniture blanket index. He had a friend who was in the furniture blanket business, and if business was moving, his economy's growing. These guys are buying furniture blankets because the movers are moving things around. So
That's
that
right.
always got me as like the anecdotal evidence that grows the economy.
Yep. So, what we're saying then is that this is that lull, uncertainty. Uncertainty is probably one of the worst, emotions that you can have in a marketplace because uncertainty means I'm not holding. I'm in and out, in and out. And that's, I think, what we're seeing. And as you're breaking these support zones, Fred, when you were talking about the 2/3 retracement, I was thinking of Howard from
Yeah,
Future Tense.
yeah,
And I was saying, Howard would always
the
say,
X bar.
a bull market is when the retracement does not hit the 2/3, but hits somewhere between the half and the 2/3.
The
And
X
if it
bar,
hits
he would
that,
call it, right? That was his.
right, and he would say that would be the most bullish signal you could look for. And you see what Morgan Stanley said overnight about Tesla, that they you got to buy it. They're looking for a 90% reversal from the lows that we've seen. Um, and how can we not expect that if what we're talking about comes to fruition about beyond June, Tim, 4 to 6 or 8 months, then yes, any cash on the sidelines got to be looking at these. For example, will it be a shocker to us if in 2 to 3 months we find out that Berkshire Hathaway has suddenly deployed some of its cash to the marketplace, during this downturn? Like, would that be a big shocker to anybody? No, not really, but
Yeah,
we're forced into that retail trading mentality of, oh my goodness, it's down 1%, now it's 2%.
You know, let me throw this out for thought because I really haven't come to any conclusions. But I think demographics have changed this market. Maybe because I'm older now and I'm thinking in those terms. Um, you got capital at work here that's not the kind of risk capital we've talked about. Yeah, the hedge funds are still throwing it around, but the investment community has aged, You know,
Yep.
certainly the kids don't have the kind of money that maybe the boomer generation had when they were kids. You've got struggling demographics in the various generations, but if you've got the older generations, they're going to seek fixed income returns as they get a chance to look at. They've seen negative returns for 3, 4, 5 years, and
Right.
and now they're looking at positive returns. So the bond market could be a lot stickier than we're used to.
The old
Meaning,
idea of
meaning that
pushing
there'll be a lot
coupons,
of
right?
meaning there'll be a lot of buying of bonds, right?
Well, buying and staying in bonds as opposed
Yeah.
to jumping into equities with both feet.
But that's bringing interest rates down. That's a positive, and I agree with you. I remember,
Yeah, I guess so.
back in our days, you bought a CD at 10, 11%, and you just put money there. Why put it in the stock market and have to up and down?
Yeah, but we were like 30 and 40 years old. Now it's
Yes,
70, 75 years old. And I would argue that that's a big piece of the investment community today. A lot of it is sitting in hedge funds, so it's
yeah.
active. Yeah, I wonder if you have an individual investor anymore. Almost all of it is caught up with professional management now. So maybe that
Well,
shoots that argument in the ass.
I know my neighbor just recently retired, and he said point blank to me, I got all my money at 5%. I took advantage of that, and I got these state munis, the which are tax exempt. He goes, I just put everything there. I'm not worried about the stock market. I get X amount now, and I can live on that, and I'm very happy. And now looking at this last week or two, I'm kind of shaking my head, going, that was a smart move.
As long as there's no inflation, and if you truly believe that inflation has been beaten, then yeah, that's the answer. Take 5% and move on. And Tim, to your point, a lot of the what were baby boomers have now looked to downsize. They take their $1 million home, their $1.5 million home, and they move down to something that's a $500,000. So they price out the younger generation because they're the ones stepping into those affordable houses. They're taking that excess money that's there and they're putting it into coupons that you're talking about. And now I can get 5% of my $1 million and I'm comfortable. And with Social
Yeah.
Security, and then I could live a comfortable life. I don't have to stress anymore. So it does price the younger generation out
I think
at a healthy way.
selectively right now, I think they talk about the baby boom or the baby boom generation being the largest transfer of wealth to the next generation. I think they talk about 50 to 60 trillion dollars over the next period of time as the baby boomers all die off. And that is an enormous transfer of wealth to the next generation. What they do with it, I don't know. But I do agree that this is a lull right now, and uncertainty is a worst, emotion to put into the trading market, and it's playing out. Whether we're at the lows now or can we go lower, I I don't want to, try to step in front of that freight train and say stop. Um, but I do know that selectively, there's a tech stocks hold the key to the future. And so selectively, I would like to be, looking in at these sell-offs. And I think that there's probably a lot of money on the sidelines. I mean, we know that Warren Buffett's got the largest amount of cash, and a fund doesn't get paid to hold cash, although their returns are pretty good, but they get paid to invest that money.
You
So
know, we're three ex-professional traders. We've traded professionally. And one of the problems that I have when I look at the markets is trying to get into not so much a retail mindset, but a non-professional mindset. So I just looked at this recent sell-off, and I haven't really seen capitulation yet, although yesterday might have been the beginning of it. And looking at it from a point of view of a non-professional trader for the second, we've had 3 really solid years of growth. Now, granted, all that growth was sugar rush growth. It was growth
Yeah.
from the public sector burning money, and it's growth based on debt. And now, if you're sitting on 3 solid years of gains as a non-professional trader, an investor, uh, and you look at this market, it might it might be easily a 20% drop if you see some people not getting short but taking money off the table.
Right.
We tend to think, okay, this market's getting short, and that's where I go wrong, but this market's not getting short. It's as much as it's just moving committed money into safer havens. And after we've seen such significant growth over a 2 to 3 year period, it would not be startling to see a 20 to 25% drop just based on money not being committed, moving into fixed income or another sector. One of our problems, I think, is we tend to think, okay, this market's getting short, this market's getting long. The short sellers are there in the funds and the hedge funds, but I don't think that's the bulk of the investment capital. I'd like
Yeah.
to see
Right.
what you think about that.
My investment philosophy over these last few months anyway has been there's still stocks that I believe in. There's still stocks that I'm not taking profit on, but I'm buying insurance. I'm buying options, 2 month options, S&P puts, so QQQ puts, buying those as protection for the underlying, and then look for opportunities to buy some of the cheap stuff that you've been talking about, whether it's the technology stocks or defense stocks or the oil and gas drillers and suppliers. That I think is a good recipe. You catch the downside without taking profit, and then you have the opportunities to use that money to
We used
buy
to call
some.
that going short against the box.
Yeah,
Yeah.
exactly.
That's a great strategy right now. And, one thing we haven't talked about is this seemingly endless release out of China about this technology that is cheaper and free for all.
Deep Seek.
Um, DeepSeek, and then yesterday there was another one that is actually, got a reasoning model with AI. I forget the name of the company that came out, but and they're talking about making that free available. And now there's no AI in the US that matches that sophistication or development level. So, and the fact that it becomes cheaper and maybe is available for all in these free spaces, just undermines what the heck is going on here in the US with all this,
But
you
having
know,
said that, Nvidia is down like 30% from the highs, right?
yeah, well, and rightfully so. I mean, they're not supposed to get any of these NVIDIA chips, and yet they're able to do all this. So what the
Right.
heck are they using? Whether it's, confiscated chips somewhere else, or whether they've figured out a way to do it without these sophisticated chips. And keep in mind, Amazon, Google, how much are they committing to purchasing all this equipment ahead of us? Um, I don't know. It's just another factor that's kind of like, as a heavy tech investor, I've kind of looked over and gone, what?
Well, where I'm getting hurt, honestly, is my quantum book. I got a bunch of quantum stocks that are out of favor at the moment, but to me, they're all like lottery tickets. Any one of them could show up and change the whole mix. So I'm taking Freddie's approach to life. Buy insurance, buy some puts. Um, the other piece of it is what we haven't talked about because there's so much to talk about here. Really,
Yeah,
we could go on for hours. Um,
easily.
is Blackstone and the
Private equity.
the private equity market, which is kind of the the shadow banking sector. Where's that in all of this? That starts to
You know,
unravel. That's a big deal.
yeah, that's a big deal.
Yeah,
Huge. Yeah.
yeah.
And I know, and, looking in this tech space, somebody said, hey, this company's doing this. And I've gone in and said, well, that's really interesting. That's cutting edge. And then I go in and it's private and it's held by one of these private equity firms. And like, okay, that would be great to invest in it, but I agree with you. How much, if they're holding one winner like that, how many losers are they holding
And you
in
can't
that
get out.
space?
Once you
And
get
they
in, you
can't,
can't get out. That's
right.
Yeah.
it's not liquid.
Yeah. It's a roach motel. You can get in, you can't get out, and they have to finance all the losers.
Yeah.
They're the bank now, and they're bigger than the banking system. I think private equity market's probably bigger than the banking system. So we used to worry about the banking system, but we should be worrying about the private equity market.
That's why I'm of the opinion that the rapidness of this adjustment, what do we want to call it, 2 weeks? I mean, the bottom's really just fallen out in the last 5 trading days. But the rapidness of the adjustment has to be a concern to a lot of people. And so I'm looking for the telltale signals here now about, I want to watch today very carefully. Does it bottom? I haven't looked, but, do we begin to base here today? How do we trade into the rest of the week? Because once the machinery has executed, you know, it then begins, then the other side comes into play. The hunter killer programs that are in the marketplace that are like, that's down 32%. What? And they start to buy back. And once these machines start buying back, it's just a simple reversal. I used to have the Economist picture from the 90s on my desk, the front cover of the Economist, where someone said, "Hey, have you heard about that new Excel?" And the guy next to him in a big trading pit said, "Sell." And then the guy next to him said, "Sell." And then the whole trading pit was selling. And then on the other side was the guy saying, "That's a really good idea. I might look to buy." And they said, "Buy." And next thing you know, the whole market went by.
Yeah.
And very much like that simple graphic visual is the way these computer models, once they've executed, they then begin to automatically look for the other side of the opportunity. So I'm going to watch today, tomorrow, or into the end of the week. If we don't see a bottom begin to form or a little bit of an updraft, then Fred, I think you're bang on. We got more to go.
Just going back to what you said about trying to flip to the other side, these models. You remember Billy that we worked with on the options
Yes.
desk, right?
Yep.
He
Oh,
worked
yeah.
for a hedge fund out of the UK. This time I saw him, and this was many years ago. I said, "How's it been?" And he said, "Well, the fund was they were Euromoney's hedge fund of the year, and they caught the CDO market when it collapsed. And the managing partner, who was the biggest trader, huge position, the huge position, short all of that stuff. He said the day we went to collect the award at the gala, the fund was bankrupt, fund was out of business because the
Wow.
guy flipped. It came down, the CDO market came down as far as it did, and he said, "Well, that's enough. It's going to go the other way. I'm smarter than the average bear,"
Oh,
and it kept going.
Well,
And there was no
this kind of reminds me trading when the central banks had these levels to step in. The fundamentals were sell, 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 and the central bank would step in and buy, and all of a sudden you're caught and you're short in a hole. And these markets are very much like that
yeah.
because they're laden with more event risk than we've seen in years. That's precisely why the VIX is at 28 or 29. The event risk in these markets are really quite dramatic, more than we've seen in many years, because there's just so many events or potential events that were out there. I mean, peace breaks out in Europe. That's an event.
Yeah.
You talked about the German economy starting to stimulate German investment. We haven't seen that in 40 years. It's been
Right.
4 decades since we actually saw Germany as a factor in these markets. So every one of these events are like plastic explosives, and they could set off a chain that you can't defend against. The event risk is like, I don't know that I've ever seen this many major event factors falling into the pot at the same time.
Tim, let me pick up the hood a little bit and look inside at just what you're saying. When you're in these periods of stability, this top of book pricing, which is where the stability occurs, everything begins to gravitate inwards. And there's so much liquidity at the top, nothing really moves that much. When you enter in these events one after the other, as we're beginning to see, the top of book automatically in the price makers algorithms automatically spaces out. Instead of having 1 million every tenth of a point, it becomes 1 million every 3 or 4 tenths. And it just opens up. So when you get the next event, the liquidity has dissipated. And of course, this is what leads to these massive cataclysmic waterfalls type of moves. Because volatility, I mean, that's going to be your friend this year, precisely as you're saying. One event comes out, it moves, then another event comes out, and it could reverse completely. But that's absolutely decimated that liquidity space.
Let me add something to that. I don't know if you guys were around when Herstad blew up. Were you? A.G.
No,
Herstad?
no.
What year was that?
This was
That was
74.
70. Yeah,
I
no.
was trading. I was a broker in those years. Herstad, just for any of people, both of the people who seem to be, who are probably listening at this point,
Yeah.
Herstad was a German bank, private bank, and they were in the foreign exchange markets in a big way. And what they did was they sold German marks against, they sold dollars against marks. And when the dollars came in to them, because of the time zones, they received dollars before they paid out German marks. And they just didn't pay out the marks. And they shut their doors. And they basically had all these dollars, and the world was round. And for years we called it Herstad risk. Well, I was a broker. And I remember a French bank, one of the top three, I think it was Credit Lyonnais, was a government bank, quasi-government bank at that point.
Yep. Yep.
I got a call, and they said, "Look, I need a price for 10 million francs," which was like $2 million. I mean, it was a marketable amount back then. And prior to Herstad, I would call up a major bank, and they would say, "All right, 15, 20." You know, one 15 pips to 20 pips. You guys know what I'm talking about. I don't
Yep.
know that our
Yep. Yep.
viewers might.
Yeah.
But I got this call and I went into JP Morgan. And the guy who was head trader was a guy by the name of Bob Van Roten. And he never answered the phones, but he answered that phone. And I said, "Bob, I have a large French bank that would like a price for 10 million francs." Now, I expected to hear something like 15, 20. And what he said to me was, "Well, have their relationship people call our relationship people, and we'll see if we can accommodate them in some fashion." And it dawned on me that if you had a position of $2, 3, $5 million, there was no way you were getting out.
No.
And this precisely to your point, the spreads widened and the liquidity ground to a halt, and the market stood that way for like 3 days. So any position you had to live with. There was no getting out of any positions. And that's exactly what the algorithms are doing today. Your algorithm is saying to you, "No, not 15, 20. Have your relationship people. Call my
Yeah.
relationship people." As long as the algorithms are still making prices, you're okay, even if they're wide. But when they stop making prices, that's when you have a problem.
When credit
Right.
becomes the factor,
Yeah.
not
And
price.
and today the computer in your 15-point market gets given the 1 million. And where does it offer in an electronic space? If it's 15.30 and it gets given at 15, it puts an offer at 20. Well, the 15 disappears and it now goes 0520. That's how fast these markets can move, all based on these algorithms that are accelerate. So back to the point, I think what's happened in the last couple of days has probably raised a lot of eyebrows, because these things can spill over as we're talking private equity. And how do they finance all these things? Now, we know they want the 10-year lower. Okay, well, guess what? You've got a great move already from 5% down to wherever we are today. And that's a huge savings. But we don't want to see the knock-on effect begin to hit the marketplace. And so that's why I'm watching these markets, whether we want to agree or not, are quasi controlled.
Well, I think what you're going to see is credit tiering. You know, I spent a lot of years in the Eurodollar market, and the price would be like 5.786 for primes, but you'd find some of these names paying 6.5 to try to get money. And you could see in the private equity space credit tiering. Carlyle is getting money at a certain price, but one of the smaller players has to pay maybe 50 basis points higher than that, to the extent that there's availability at all. And I think you could see credit tiering in the private equity space, just like we used to see in the Eurodollar markets in the banking space.
Sure. Sure.
Yeah.
And your credit worthiness will get you the preferential spread.
Yeah. You know, I designed a matching system. I invented a matching system in the 90s for the Eurodollar market. So I spent a lot of time in that market, in the intricacies of that market. The tiering is the major, the numbers mean less than the names.
Right, right.
And that's the difference. In the foreign exchange market, you got an off-balance sheet market, you know.
Right.
And when you're talking about a market where you're giving money against a security, but a pure credit market is another animal altogether. And that's what we're talking about in the private equity sector.
It would be a very simple, algorithmic change. I mean, it's all preset. So once your creditworthiness has been established, A, B, C, D, or
Yeah, and
E,
it could change tomorrow. It
well,
changes every
yeah,
hour. It changes
every
every
year,
day.
Yeah, so I'm really picking
yeah,
up on your point. You were talking about the prices widening. I'm talking about the credit spreads widening in addition to the prices widening.
right, right. But okay, yeah, I get you. It would be a simple algorithmic, change to a model to be able to accommodate that. I don't think the foreign exchange market is far from that today in the way it prices.
Yeah, yeah. Credit worthiness determines the price.
Yeah,
You know,
yeah.
as that widens, this widens.
It's 515 for you, but it's 340 for him.
Right,
That's right.
right.
Right. Yeah. And yeah, I could see that tiering, but of course, the transparency to that would become an issue at some point in time. But either way you look at it, um, these markets are going to make some major adjustments here.
But the next
Um,
question is, we're talking about private equity and funds. What happens when that turns into governments? Where you don't trust this government or that government, and you got to lend money, and paper starts to float out. I mean, we saw that with when the euro came into play, that Italian bonds were trading at so much over. So many people made big money on all of the Greek bonds and the Italian bonds as everything came to par. That was the play, not trying to guess where the foreign exchange market was going, but those interest rates had to converge. And
yeah.
now I'm just saying maybe they're going to converge the other
Well,
way.
all you have to do is look at the credit default swap market and find out. That's where it'll show up. CDS market will start to demonstrate those kinds of spreads. And I think that's the thing to watch. That's really what we should be looking at more than anything, I think, right now.
Does that market react very quickly to those type of subtle
I've
changes
never been on
underneath?
the inside of it, so I don't know the answer to that.
Having watched late night movies, now that in retirement, I've watched that movie about
Big
six
Short.
times, The Big Short.
Yeah.
Yeah, yeah. The credit default swap market is the place for the sovereign risk. Inside the other tiers, I guess you'd have to look at the corporate bond market and see the corporate bond market respond to credit squeezes.
Triple
Right.
Bs and the triple Cs, and
All right, Steve, you've got your homework there. There you go.
Yeah, definitely. I've got a lot of things to check up on, but it's been an interesting talk, guys.
yeah. Thanks for coming on, Steve. We
Yeah,
appreciate it, and
one thing, Fred, I think that we could all echo, Tim. We've all come through this period of time. Let's use 2008, and all the comments that have come out. These downturns present opportunities for the big sharks out there in the world, and that's why, to me, I'm not going to be one bit surprised if in the months ahead, when these reports come out, that I'm going to learn that so and so, just took 4%, 5% of this, opportunity. Maybe not today, but this period.
Yeah. It's a
if you got
wild,
deep
wild
pockets,
days. Wild
if you
days.
got deep pockets, there will be a lot of opportunities. Yeah. Yeah. Well, all right, guys. Thanks very much, Steve. Tim, thanks again. And just a reminder to everybody, please subscribe, tell your friends, and we're going to be doing this again soon.
Okay,
Thanks,
guys.
guys.
Take care.
All right, guys, take care.